Look, gold and silver guys, they broke out gold in 2019, June, silver in 2020. They broke out already ahead of this. So now what's going to happen is it's the next wave. So people got to stop saying gold and silver haven't reacted. They have reacted.
So Patrick, the audience has been, I've been seeing it on Twitter. I've been seeing it on Reddit. Lots of people are concerned that the gold and also the silver market, the chart patterns are saying bear market, right? It's like 2013. What are the charts telling you? I mean, is that a valid concern people have right now?
Well, this is what happened to me when I discovered chart trading. Like, I just believe in classical chart trading. I looked at I didn't care what the ticker was. I just look at chart patterns. If it break down, then, oh, it's a breakdown. And then I'd have these crazy downwards measure move targets. But what I've learned is over time is you can't do it like that. There's macro evidence, there's long-term cycles, there's ratio charts. So a pattern, you have to weigh the probability. So yes, you have a pattern today. The gold is below its 3-year moving average. It's below a inclining trend line. So of course you have to look down, but you have to also look at the macro landscape. Where and when is this type of breakdown happening? Okay, guys, let's start. Top left corner, SPX divided by PPI. So that's the producer price index. That's the producer price index. It leads like CPI. So this is producers, how much it costs, their services, their input costs, like commodities they have to buy, whatever they have to do to produce the goods that we consume. So essentially, that's the best proxy for inflation. So if SPX cannot outperform PPI, then we are in an inflationary cycle. So all the macro drivers, margins are shorter, smaller price earning ratios. They're not expanding, they're contracting. So let's just do the TA on this. I'll go back to here, 1920. Here, beautiful rising trend line, 1, 2, 3, 4, multiple touches. And once you close below that rising trend line, which is at a 62-degree angle, I call that the sleep mode line. That's when US equities, their bull run has ended when measured in inflation, and it goes sideways. Here was I think not the GFC, but the Great Depression, that market crash of 2029. And then for years, like, I don't know, you could calculate the amount of years, but anybody who bought this top here, that's 1930. Then that's like 1950. It took 30 years to break even. So unless you had dividend paying stocks to try to offset this, you were trapped. This, for me, if you're below the sleep mode line, stay clear of growth stocks. Just stay clear of them. All right, here's the bull run, early breakout line. Then you favor US equities versus commodities versus stuff that hurts you when they drop on your foot. 1, 2, 3, 4, 5 touches and a breakdown. And more than that, it's breaking down, but also below the 7-year moving average, which I overlaid. And in TA, a moving average is more valid. Let's say it's tracking a trend line and they're both in harmony. So it's not like a shorter term moving average, which is squiggling and giving whipsaws. This 7-year moving average is actually tracking very well this rising trend line. So it gives even more meaning when you close below that rising trend line and the 7-year moving average. And what happened here, 1969, US equities started plummeting versus PPI. It tried to do a new high, but damage was done. This was because of this signal, the move back up in favor of US equities, that was the last greatest opportunity to go long commodities, because we know what happened in the 70s. Mm-hmm. It just went sideways, and then gold, silver went up silver went up close to 2,000%, gold, oil, 800%. This is the 1980s to 2000 bubble run, 1, 2, 3, 4 touches, breakdown. What happened again? 7-year moving average, trend line break. Game over for US equities, get out of growth stocks. They could not ever regain those dot-com bubble highs, and they were just vulnerable to every time they go up, oil's going up, and it's just sucking the wind out of all these growth stocks because their margins are getting killed by higher commodity prices. And all these, they last multiple years, like 8, 10 years, 8, 10 years, 8, 10 years, then go long. And this was the last rally we had for US growth stocks. 1, 2, 3, 4 touches, break on the 5, super meaningful. And we actually have a confirmed breakdown below the 7-year and that rising trend line. You have to look up because.
So what's the next chart that you have that sort of ties in with this?
Okay. Stagflation, baby. Stagflation. Look, I don't know what the true definition of stagflation is, but from my grasp of it, is many recessions. So negative GDP for like a couple of quarters, and maybe you get a positive growth GDP, but then you get other quarters of negative growth in an inflationary cycle. So I just had fun. I overlaid the green bars here are recessions. I got that's the data from the Fed, directly from the Fed. And I decided to count the number of recessions that were every time I was in that bear mode, when the SPX was underperforming SPX. I said, how many recessions? Like, do we have more recessions when SPX is underperforming inflation? And yes, so right here from 1914 to, and all of this bottom, I had 4 recessions and some thick ones, right? So these are probably 3-4 quarters of recession, maybe depressions, depending how you declare them. On the way up, when it's pro stocks, it's reflation, a disinflation cycle, pro growth, then you have less recessions. They're less severe. Here's one. Look at here, the Great Depression, 1, 2, 3, 4 recessions in this bear market for US equities. On the way up here in the 60s, a few here, 3, but after that, in this stretch here, no recessions. And this is important because I'm going to show you what's happening today. No recessions. People think recessions are never going to happen again. It's a good time forever. But after that, once you break down below sleep mode line, in the 70s, we had 4 recessions, 1, 2, 3, 4, even in the early 80s. And once you expunge all that bad stuff, that bad, whatever excesses of that run up, then you're able to go back up. Look at that run we had to 2000 .com bubble. I never noticed this. We had a tiny recession here and a recession on the way down. So after the .com bubble, when it was busting, we had a recession here. It's super light. Here we had depends like where the cutoff is for this recession, but we had a larger recession in the GFC, right? So when you're below after that sleep mode line, you're at risk of having more recessions. Here on the way up,
as an amateur just looking at this, it looks like we're really due for a recession right now.
Yeah, it's like, and nobody thinks we can have one. It's like here we had a tiny recession right here on the way up.
That was the COVID, the little COVID recession, right?
That's right. So when we're below the sleep mode line, you're at risk of having recessions, and that's what history has shown us, right? 2 recessions, hard recessions, depression, 4, and I think right now we're in a recession. Like that's what silver and gold are telling us, right? So we're probably in the midst of our first recession below that sleep mode line.
Yeah.
And so every time you see the U.S. equities coming back up, I think because of inflation, higher commodity prices, energy costs, it's just going to suck the wind out of each rally. And until we've done these 4 recessions, we're at risk.
This period that we're entering, where we're breaking down, below this line. How does gold and to a lesser extent silver handle this type of change?
They do great.
All right.
So here is those same lines that I overlaid. Here gold was pegged, but as this drop happened, gold went up 100%, silver went up 200%. And here I could have put oil on the log chart, but I measured it on another chart. Oil went up 400%. It went from 70 cents a gallon to almost $3 US a gallon. So
the beginning of this block, so that's the beginning of the breakdown period that just happened.
Yeah. Okay. So I put a line right where we are now, or a little bit after. So here's the silver price. Yes, it dipped a little bit, but it's the macro tidal waves forcing fund managers to let go a little bit of growth and add commodities in their basket, in their billions and trillions of dollars they're managing for their customers. It forces these moves upwards. And this is when you buy the dip in commodities, when you're below this line here, and you don't buy the dips in growth stocks when you're below that line. Gold, silver, oil, look at these huge moves in the 70s, even here.
And these are multi-year moves. I mean, let's ignore the one back in the 30s because gold was fixed and it's less relevant to what's going on now. But the 70s and the 2008 period, those were each multi-year movements, right? And what was the time frame of these bull markets?
Well, right here, I have it at 69 to 1980. So 11 years. It depends where I put it right on the breakdown line. Here, I put the breakdown lines a little further along as the NASDAQ was under, or the SPX was underperforming PPI. And here that was a 2002 to 2011, 12. So another 9 years, 10 years. And we just got the signal once again.
All
So
right. So you're calling it right now. We're saying 2022 to 2031
yeah,
is
yeah,
we're in for a a a 9 year bull market year.
yeah. And those are the probabilities. So look, if ever the chart proves me wrong, if ever we get back above these early breakout lines in favor of SPX, okay, that's it, guys. Let's call it quits. And let's go
Yeah.
along Tesla or whatever the next fad's going to be coming out of this, right? And usually it's not the same leaders as before. That's where people get trapped, but that's probably another discourse. But right now,
This is really interesting. This really makes a good argument, and it sort of aligns fundamentally. Like I've been picturing the period of time we're in right now is equivalent to early 2008, where everyone's selling everything right now because everyone's sort of anticipating a crash, even worse financially, another GFC, right? Everything's falling apart right now economically. The Fed's still raising rates. We're expecting something to break. But as soon as the Fed pauses and pivots back to easy money, then everyone's expecting, all right, that's when gold and silver will take off again. And sort of that timing sort of aligns with what you're talking about here in this chart.
exactly. It's weird because sometimes you look for analogs, but it could be a GFC at the beginning of a cycle. We might have a GFC here. We might have a bigger GFC in 5-6 years, a bigger one. Like
Yeah.
we're always looking for analogs. So of course here there's room for a pullback to try to do a new high. U.S. equities will not give up that easily. So they'll try to go back up. And silver and gold, they might be outperforming as U.S. equities try to go back up, but that's going to be the next bear trap. People, or let's say people are going back long growth stocks, and they say, okay, commodities, they're not going to make it. That's probably the last bear trap. So all those commodity bears, they'll get trapped one last time as U.S. equities reflate if they can, because I don't know where this line is going to end. Is it going to keep dropping here, like water falling like it did in 2001, much lower down here? Is it going to do like in the Great Depression there? Is it going to like really go super down? I don't know where the underperformance of this.
Everyone says we're about to enter a recession, and sort of it's all pointing at that right now. And what you just showed on your charts, we're definitely due for a recession. Probably multiple recessions this decade, if what you just showed us is accurate for what happens once we get below that line. And then you got to ask yourself, what's the Fed and the US government likely to do in that scenario? They're probably going to start, increasing unemployment benefits, increasing food stamps, increasing stimmy checks. And then who has to finance those things? The Fed. So yeah, the macro economic setup really supports what the chart's telling you is likely to happen. And, then gold and silver should, people have been surprised that gold and silver have not responded sooner, but, I just got to think that we're due. It's due to happen. They're going to start performing the way we would expect in this environment.
Yeah, look, gold and silver guys, they broke out gold in 2019, June, silver in 2020. They broke out already ahead of this. So now what's going to happen is it's the next wave. So people got to stop saying gold and silver haven't reacted. They have reacted. They're not doing new lows below 2015 highs. They're at higher lows, like $17, $18 is higher than even those March Madness lows at $11. Gold's
you got to zoom out on the chart and look at the big picture, not just the past couple of months.